If you want to make money in the stock market, then stop this insane behavior. Let's talk about it. Here's the problem. I don't have a clue why the market sold off like they did on Thursday. Maybe it was the employment numbers. I don't know, but does this make any sense? And by the way, it's interesting to compare ChatGPT when you ask it why the market sold off. It says maybe there were some U.S. economic concerns, Japanese policy changes, Japan raised their interest rates. What's interesting is this is totally incorrect. In response to these events, investors fled to safer assets like U.S. Treasuries. No, they didn't. They ran away from U.S. Treasuries, as you can see here. They sold them off. So ChatGPT, Now let's take a look at what Grok said. Well, Grok said, Federal Reserve's actions and statements. Yeah, that could have come into play. Economic data, possibly. Bond market dynamics. That makes some sense that people felt that it overshot. Recession concerns easing. That should be a positive. Market sentiment and positioning. Other tech sector influence. So this seems a little bit more reasonable. And when you combine it with the first two from ChatGPT, number 3 was totally wrong. So going back to what I said, does this make any sense? Really? I mean it. Do you think these geniuses who sold on Thursday were smart enough to get back in by the end of the trading session on Thursday when the market was down 1.3%? The obvious answer is no. Look, over the short term, the stock market is a voting machine, as you can see here. But over the long term, the stock market is a weighing machine. What do I mean by this? Well, in the short term, the stock market moves according to the dollar volume of buy orders versus the dollar volume of sell orders. If there's a larger dollar volume of buy orders than sell orders, the markets or an individual stock will go up. But if there's a larger dollar volume of sell orders than buy orders, the opposite will happen, as you can see here. But over the long term, the price of the major indices and the individual stocks in them will be related to the growth and the quality of their earnings and financial statements. This idea that investors need to do something in reaction to a single news event is nuts. It's absolute insanity, so don't do it. Look, there are many facets and events that drive the economy and the earnings of publicly traded companies, so reacting to a single news event or economic report is insane. Even back in 2020, when COVID became obvious, would you have been smart enough to sell your stocks here or here before they dropped 35% or more, and then be smart enough to buy them back here in late March near the bottom? No, you wouldn't, so don't even try it. Look, if you want to make good returns as an investor in the stock market, then don't listen to CNBC, Bloomberg, Reuters, or any of the other financial news networks, and certainly don't go and sell everything, ever. But it's much worse than just this past week. This insanity wasn't confined to just this past Thursday. Look at the S&P 500 over the past 20 days. It happened here, 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 and here, where this most recent drop was on Thursday. If you reacted to any of these moves, you most certainly wouldn't have sold at the peak. No, in the best case, you would have sold partway down, or worse yet, more likely near or at the bottom. But wait, there's more to the damage caused by this insanity. When would you have gotten back in? Would you have been genius enough to buy back in down here near the bottom? The answer is a resounding no. So don't try to get cute and sell your equity holdings just because the market is dropping or some news event scares you. Why do I keep pounding the table about dollar cost averaging? Well, because if you keep buying during regular intervals, your returns over the long term, and I mean 5 to 20 years, will most likely be triple your returns if you try to time the markets. Hey, I'm not kidding. Just look at the returns of the average investor versus the S&P 500 over the long term. You can see here the average investor has severely underperformed the S&P over the long term. I mean, over 20 years to get a 5% return when just by staying put, you could have had almost a 10% return. That's insanity. But the real killer here is look at the average bond investor returns. Now, I guess I shouldn't be surprised by this. Bond investors are inherently afraid and risk averse. So when they see risk in the bond markets, it looks like they turn tail and run. And then they don't get back in before the bonds go up. So they also severely lagged the aggregate bond index. And by the way, these returns are nothing to write home about. And certainly these are awful. You're not even keeping up with inflation here. Oh, and by the way, this is a topic for another video, but it might also make sense to dollar cost average out of your investments when you need to raise cash to cover your living expenses during retirement. Now there's a thought. What do you think of this craziness in the markets lately? Did you sell during any of these recent downward moves? Or did you dollar cost average in and buy more? Please let me know in the comments below. With all of that, let's go through the current health of the stock, bond, gold, and crypto markets. So if we take a look at how the equity markets did over the past week, you can see that we had a fairly nice rally going on here. And then Thursday, the markets just sold off like a maniac. And then what happened on Friday? Boom! They came back and gained it all back and then some. And you can see this is a very, very healthy appetite for risk with ARK Invest and small caps right up here at the top. In fact, if you look at the action, the price action on Friday, look at IWM up 3.19%, almost 3.2%. The NASDAQ up 1.08, S&P up 1.06, and the Dow up 1.07. And look at Treasuries. TLT up 0.65% and EDV up 0.76%. And if we look back over the past month, you can see we had a big pullback here, and there's just been this very steady climb higher, except for Thursday. But then on Friday, not only did it recover the losses from Thursday, it surpassed the previous highs. This is a really healthy appetite for risk. And what if we look at year to date? Well, year to date, obviously, ARK Invest is still underwater, but you can see that the NASDAQ is right up here with the S&P 500, and the small caps are right here with the Dow. And then if we look back over the past year, this is actually looking really good. The NASDAQ is in first place, S&P in second. Now, small caps and the Dow are kind of tied for third, and ARK is in last. But look at the slopes of ARK and the small caps. These are going to shoot higher and surpass these other equity indices if things continue moving higher. So how does everything look when we take a look at equity bottom dynamics? Well, this is really encouraging. You can see that the black line is the S&P 500 for those of you who don't watch my videos regularly. I sort of jump into these assuming you've been following. But the blue line is what's called a bottom confirmation signal. And to get a bottom confirmation, you need this signal to be up here at or near 100%. And you can see it's pegged right at 100%, not going anywhere. But what you also need is the confidence level to be up here, ideally at 100%. But look, it's in the mid to high 90s here. So we absolutely have a combination of a bottom confirmation signal and herd behavior driving these markets higher. This looks really, really good going forward. And what if we look at risk versus opportunity? Well, this is starting to look better. You can see that risk acceleration was way up here. And I cautioned back then that I didn't think this was going to last, and it hasn't. Look at this. Risk acceleration is falling. It's below 60. I'm real happy with that. And you can see that opportunity acceleration, these two are the sort of leading indicators. You can see that turned higher on Friday and is moving up. So this looks really good. Now, the risk is very much of a lagging indicator, but it also turned down. And then opportunity level is very much a lagging indicator, and it's just basically following opportunity acceleration. It's still moving lower. But if opportunity acceleration continues moving higher, this will probably lag by about a month or so, but it will turn around and move higher. And what if we take a look at equity versus safety? Well, I really like what I'm seeing here. Let's jump right into the overlays. Look at this. The NASDAQ 100 from 9th place to 2nd place in just 1 week. This is fabulous. And the S&P 500 moved up several notches. The Dow moved up. And I love the fact that cash has collapsed down here, not only to the bottom half of this table, but all the way in 8th place. Now, IWM is stuck down here in 10th place. But let me tell you, if it continues to perform the way it did on Friday, this is going to move up here very, very quickly. And what if we look at safe haven assets? Well, you can see the longest duration treasuries are ranked number 1. TLT got displaced by the NASDAQ 100 moving up. That's fine. Intermediate treasuries got displaced by this S&P and the Dow and the NASDAQ all pushing higher. All of these got displaced by the NASDAQ, the Dow, and the S&P moving up in the rankings. And how does all of this show up in the buying and selling pressure? Well, this looks good with a little bit of a caution. So we've got very nice price moves higher here in every one of these indices. You can see that here. And ARK Invest, same picture, very nice price move higher. Well, what gives me a little bit of pause here? Well, if you look at how the buying pressure, the solid gray line, peaked out here and has been falling as the price has been going up, this is a divergence. And by the way, the selling pressure is moving higher. This is giving me a little bit of pause. And let's look at the S&P 500. Same thing, divergence. Falling buying pressure, rising selling pressure with rising prices. NASDAQ 100, same picture. Now, small caps, very different picture. Rising prices, rising buying pressure, falling selling pressure. So am I concerned about these going into next week? Well, yes and no. Short term, this doesn't look good. But then look, if you go back a little further, you can see that the buying pressure, even though it pulled way back here, it's still trending higher overall. And the selling pressure is still trending lower. So kind of a mixed picture here. We could see some softening early next week, but who knows, right? The markets could just continue blowing higher and these divergences will just go away. And what about sector rankings? Well, I always kind of gloss over this because these are very, very much looking in the rearview mirror. So if you want to pause and take a look at this, go ahead. I mean, this is basically telling us where things were, a week ago, 2 weeks ago. So let's jump right into sector rank acceleration because these move more quickly. They kind of give you a sense of where things are headed rather than where they've been, especially when you look at the change from week to week. So what is there to like here? Well, quite a bit. There's a lot of green arrows on here. You can see that 20, I didn't draw green arrows on all the treasuries, but they've all moved lower, which is actually good for equities. It means there's not a flight to safety and that investors are focusing on equities and higher risk assets and less on safer assets. So that's good. Same thing with cash, moved a lot lower. What's looking good here? Consumer staples moved down. Now, these are equities, but the fact that they're moving down while consumer discretionary is just launching higher up here in the rankings, this is fabulous. And we've got ARK Innovation moving way up. I mean, there's a lot of green arrows in here. Technology moving up, clean energy moving up, and semiconductors moving up. So this looks really, really good. What is there to dislike? Not much. We had gold moving higher. We had small caps actually moving lower, even though on Friday they really blew higher by a lot. But it's going to take a while before that shows up here. And also, the S&P 500 fell in sector rank acceleration. But again, if it continues moving up the ladder in equity versus safety, this will turn around over time. And speaking of treasuries, let's talk about them. Well, as I showed you earlier, they rallied into Wednesday, into Thursday, and then Thursday they just got pummeled, but came roaring back on Friday. Now, unlike equities, they didn't surpass their previous highs, but this is, given that equities went up so much on Friday, this is a really good move for Treasuries. And if we look back over the past month, this is a very healthy relationship with longest duration EDV on the top, 20-year bonds TLT next, and so on. This is a very healthy relationship. And if we look at year to date, you can see where we've been and where we are now. We're almost back to even since the beginning of the year. And what if we look back over the past year? Well, we're above water. We're above where we were a year ago. And you can see that the longest duration treasuries are just shooting higher. This is very healthy looking. And how does all of this show up in the buying and selling pressure for treasuries? Well, you can see the overall over this 2-month period, all of the treasuries have been moving higher for sure. You can see though that the buying pressure peaked out back here and has been declining. Now you could say this is somewhat of a divergence, at least in this case, although these prices are moving just slightly higher. So these might take a breather into next week. But you can see on intermediates, we've got buying pressure shooting higher. In 7 to 10-year treasuries, buying pressure moving higher. And in long bonds, buying pressure moving higher. So this looks really, really positive for treasuries going forward. And what about that inverted yield curve? Well, I think very soon I'm going to have to stop saying inverted yield curve. You can see that we're only 13.5 basis points inverted. Now, not too long ago, about a year ago, we were 110 basis points inverted. So we've come a long way, baby. And you can see what's happening here. A year ago, interest rates at the short end at 1 year were at 5.364%. A month ago, they were 4.879. And now today, 4.428. So they have really dropped. And I guess 2 years is the place you want to look. But again, a year ago, 4.97. 1 month ago, 4.49. And today, 3.972. So what do the markets think the Fed's going to do? Well, they're not quite sure. If you look at last week, there was a 75% probability that the Fed would lower rates by 0.25% when they meet in 3 weeks, 4 days, 15 hours, and 32 minutes from now. You can see what's happened, though, as we go forward. Now, this likelihood has dropped to 64%, and this has moved from 25% to 36%. So there's a higher probability, and more of the market's starting to think that the Fed could likely lower rates by 0.5%. Now, personally, I don't think that's going to happen. I think the Fed would be afraid of scaring the markets if they drop interest rates by 0.5%. But who knows? And then if we go out to November, a quarter rate is totally baked in because this is a 0.5% reduction here. This is a 0.75% reduction. And this is a 1% reduction from where we are now. So likely, very likely, interest rates are going to be a lot lower by November 7th when they meet. And what about gold? Well, gold has been going up very nicely. I stay away from gold because I don't want to own gold bars. And if you buy this ETF GLD, I think you end up paying taxes, even though you haven't realized the gains, which is absolutely nuts. But yeah, you can see that the buying pressure moving up very nicely, well above the selling pressure, and the price is moving higher. Now, I'm not surprised. Look at where the selling pressure was. Whenever the selling pressure gets way up here or higher, you know that things are going to turn around and start moving up in the price. And that's exactly what has happened here. And by the way, the opposite is true. If the buying pressure, this solid gray line, gets up at a very high level, the price tends to decline after that. You can see that happen back here. And what about Bitcoin? Well, talking about peaks in selling pressure, here we are. And Bitcoin has been moving higher. Now, look at where the buying pressure is. It's shooting higher here. Now, that doesn't mean this is going to turn around immediately on Monday and head lower, although it could. This could continue shooting higher. We're just going to have to wait and see where the break point is, and then we'll know we've reached a short-term top. As you can see from the price movements and metrics in the buying and selling pressure charts for equities, the equity markets are trying to recover and move higher after the recent pullback, with the ARK Invest's ARKK Innovation Fund and small caps leading the way, and Treasuries have been rallying nicely from their recent pullback. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.